Steve, we were just talking during the break how volatility has picked up a little bit, and yet today we're seeing a pattern that has become all too familiar, right? You get a sell-off, and then in the last hour or so of trading, you get what appears to be a buy-the-dip phenomenon where stocks come up off the lows. How much of this is a factor in the day-to-day trading?
It's become the market it's become a real feature of the market. One of my colleagues and I looked at each other about 10:30, 11 o'clock and said, all right, at what point do they get the market back to unchanged today? And it wasn't because we felt there was any real buying coming in. It just felt that the selling had dried up. And then when that happens, I think that investors, whether we talk about them being automated or not, have gotten conditioned to looking for opportunities to buy dips because it's worked. Why would you not do something that's worked for you for years, even if that may not be the thing that works tomorrow? It's been working for you so well in the past.
And is that one of the overall elements too that has just suppressed the that has helped to suppress the volatility, that you do get this programmatic trading that's become pretty dominant in the market?
Well, it's absolutely a feature of it, and we don't have time to go into all the reasons here, but there's a lot of strategies that dampen the volatility. One of them would be just the amount of open interest that's available in all the options going into a quarterly expiration on tomorrow, basically.
Right.
And so, you know, if you've had let's say your long puts and you've gone through the strike, well, then you're going to buy stock against it. Well, you know, at some point that provides a dampening effect. Buy low, sell high is what happens if you're long gamma. And I think because of the amount of customers who've sold and professionals who are long, the professionals tend to delta hedge, and that provides a lot of the dampening effect to the market.
Now, where we have seen the pickup in volatility, it's been largely concentrated in tech, of course. We've talked a lot about the FANG stocks coming down. Your trade today has to do with one of them, Netflix, which you see as sort of the weak antelope in the herd, or however you want to put it. We have a chart of Netflix versus its moving average, and right now it's perched right at that 100-day moving average. Why is this important, and why is it the weak antelope?
Well, it bounced off it this morning, but it definitely seems to be the laggard among them. It's really one of the only ones you can say that's perched against a major long-term moving average. The reason I see that as being the weak antelope, so to speak, is their business model is not that different from the others. I mean, really think about it. Facebook has such a commanding presence in social media. Netflix is in a business that 3 of the other FANGs are in and competing with them in. And they're more or less a one-trick pony. So I think that makes them more susceptible to a downturn. I'm not in any position to say that it's imminent or current. I happen to like Netflix personally.
As a consumer.
As a consumer. But I think that you have a bit more risk. And as the concentration narrows, you've gone from a broader index to essentially the FANGs. It's not hard to imagine that the one who's got the weakest business model would be the one to be the next one to drop out, and that's why I would say to look for trades that protect against that in case that moving average is broken.